Hey, what's going on, everybody? So, last episodes we kind of established this rationale for money, and a modern kind of framework for monetary policy in general. And so today we're going to kind of delve into the microeconomic foundations of the banking sector itself. So we're going to use this model. It's called the Diamond-Dybvig. Okay, model. This is a model. Okay, and to understand, really, we want to understand the essential kind of value creating function of the banks. Like what value do they create, and the inherent kind of fragility that arises from this very function. Okay, so we're just going to see how we can transform from short-term savings into long-term investments, and by doing that, we simultaneously create the risk of financial panics. Okay, so the core function, okay, is maturity, or the core topic really is maturity transformation. Okay, and liquidity insurance. All right. Banks really are not passive intermediaries. They actively create value by performing something that we call maturity transformation. This basically means that they accept short-term liquid liabilities. And so these liquid liabilities are just, you can think about them as like, deposits that can be withdrawn on demand. Okay, so somebody just goes to the bank like, hey, can I withdraw my money? Okay, so this is liquid liability. And we want to use them basically to fund more long-term, illiquid, or higher yielding assets, so like loans to businesses and households and stuff. Okay. So that's kind of what they do. They accept these short-term stuff and then, lend it out to more illiquid but higher yielding assets, right? Now, the Diamond-Dybvig model, Dybvig model is elegantly going to demonstrate how this process of maturity transformation demonstrates really how this is a form of a valuable kind of insurance, all right? This is a valuable insurance against individuals' uncertain need for liquidity, all right? So let's consider this, let's just illustrate this with some three-period economy. This just means that t can be equal to 1, 0, 1, or 2, okay? These are the periods. And agents, so let's define something called an agent. Agents, there's a large population of identical agents in this model, and each is endowed with one unit of a good at t equals 0. Okay? So each agent has one unit of a good at t equals 0. So there's also something we need to define, which is preferences. So at t equals 1, so the first period here, each agent discovers their type, okay? They discover their type. All right? So with probability, lambda, okay, we're going to define this probability as lambda. An agent, an agent is impatient. Okay? They're impatient with this probability, and they get utility only from consumption at t equals 1. Okay, so they're said to be impatient with some probability at t equals 1. At the first period, they reap their utility by means of consuming something, C1. So the utility that this agent harvests, this impatient agent harvests, is given at some consumption 1, okay? And then we're assuming this consumption is associated with this time, okay? Now, with probability 1 minus lambda, all right? It's going to be the opposite. An agent is patient. Okay, an agent is said to be patient and gets, utility only from consumption at t equals 2, where the utility that we scraped from the utility function is a function of the consumption, okay? And so the utility function in general, u of some, of something, right, is standard. Okay, we would say that it's standard, and this basically just means that it's increasing. Okay, it's increasing and concave. All right, and so because it's increasing and concave, with some u prime, okay, u prime at 0, if it's increasing and concave, we also want to define that its derivative is actually infinity. Okay, so the utility function should look, in general, should start off with an infinite tangent line. Okay, that just means that it's a standard utility function. Okay, that's how we're defining it. And so agents don't know. Also, they don't know their type. Okay, or their preference at t is equal to 0. So we've set a problem here where if we have an impatient agent, they're just gonna, they're gonna have this utility. If they're patient, they're gonna wait and get the other thing, but they don't actually know their type. Okay, and so this uncertainty here in their type represents something called a liquidity shock. Okay, so the uncertainty in their type represents a liquidity shock. And this liquidity shock is just an unforeseen need for cash. All right? They don't know, they're not aware, right? I wasn't aware. I just got an iPad, right? And I wasn't aware that, I needed some cash to go to the store and get an iPad charger, right? Because I left it at home, okay? So kind of similar to that, okay? Okay, so preferences. We've defined preferences, and we have to discover some type, okay, that we need. And this is interesting because I usually stick with Android, operating systems and stuff for everything. So, the Apple is unforeseen, okay? Me needing an Apple charger instead of a Type-C charger is unforeseen. All right, so technology. We also need to define this, okay? So this is all part of the Diamond-Dybvig Model. I keep saying it wrong. But two investment technologies are available at t is equal to 0, okay? And this is not technology in the sense, but investment technology. So a liquid asset, or you can think of this as storage, it's more well defined economically. It's storage. So a short-term technology Okay, this is a short-term investment technology that yields 1 unit at t is equal to 1 for each unit invested at t equals 0. Okay? That's an equal sign. So that's the definition of a liquid asset. And then an illiquid asset we can think of this as a project, some kind of undertaking. All right? This illiquid is a long-term technology that yields some high return. Okay, let's call this R is greater than 1 at t is equal to 2 for each this is a unit, by the way, for each unit invested. T equals 0, okay? So the point of this, instead of just holding cash, right, we don't just want to store our cash, but we want something that's going to grow. This would be an illiquid asset, all right? And if this investment is liquidated early, so if liquidated at t equals 1, or if the agent is impatient and they liquidate it early, this yields only, let's see this, hold on. This yields only L is less than 1. So this basically means that we have a penalty for early withdrawal. So the key trade-off, right? This is a trade-off. This implies a trade-off. And this trade-off is between return versus illiquidity. Return versus liquidity, okay? So there's a trade-off between the returns that I could have, but I don't have access to them, or I'm penalized for withdrawing early, versus being able to have liquidity, some easy way to store money. Okay. Now let's talk about self-insurance, right? So this is the Diamond-Dybvig Model. Okay. All right, sounds good. So let's talk about autarky, okay? And this would be, of course, the idea of self-insurance. Without a banking system, each agent must self-insure, okay? So that's kind of like, this is kind of an axiom, right? If there's no bank, this is what we have to do. So at t equals 0, an agent could invest in a portion. So an agent could invest in a portion. Let's call this I1 of their endowment in the liquid asset, and I2 is equal to 1 minus I1, okay, in the illiquid asset. Okay, so there's two choices, okay? So if the agent is impatient, what happens? They would consume what they held in the liquid asset. So you would say C1 is equal to I1, okay? And they must abandon their illiquid investment. So that's what happens, okay? So they abandon. Okay? Now let's say an agent is patient. Well, if they become patient, they will consume their illiquid investments return plus their stored liquid funds. All right. So what this looks like mathematically is the consumption will look like 1 minus I1 times the return, okay, plus I1 plus their initial investment. So you multiply the return by 1 minus the investment, okay, plus the initial investment that you had. This is inherently inefficient. If an agent, the reason why self-insurance is inefficient is because if an agent invests heavily in the liquid asset to guard against impatience, they might forego the high return, okay? They want that capital R, and if they turn out to be patient, okay? And so if they invest heavily in the illiquid asset, okay, in some illiquid asset, they're left with little to consume if they turn out to be impatient, okay? So there exists, okay, a social gain to be had from pooling these idiosyncratic liquidity risks. All right. Hopefully that's clear. So now we're gonna say the bank. We're gonna look at the bank functioning as a liquidity insurer. So the bank, its function is to ensure liquidity. Okay, so a bank can it can improve upon this idea of autarky. Okay, so if we pool the savings of by pooling savings of all agents, okay, it can rely on the law of large numbers, okay, because if we have a bunch of agents, the bank acts as this kind of statistical, some kind of statistical culmination of pooling savings from everybody, okay? And so it knows that on average, right, a fraction, let's call it lambda, of its depositors, right, will be impatient. Okay? And because the fraction of them that will be impatient is directly encoded into the probability of them being impatient, the bank offers a deposit contract that promises the payment. It promises a payment of C1. Okay. All right, and this is basically aimed at anyone who withdraws at t is equal to 1. And it also gives C2 to anyone who withdraws at t equals 2. Of course, So by ensuring liquidity, we can then avoid this idea, this idiosyncratic liquidity risk, that can then be pooled into savings of some statistical kind of culmination of all agents. All right, and so let's derive something, and we're going to derive the optimal deposit contract. Okay, what does that look like? Well, that's actually going to look like an objective. So a bank's objective in a very rigorous sense is to maximize, maximize the parameters C1, C2, I1, and I2 is to maximize the X ante-expected utility of the representative agent. Of course, we want to maximize the utility, and this is all subject to the following constraint, where we have the probability, or the on average, this would be the amount of people that are impatient and need to have their utility function, they need to scrape that utility from, not from being impatient, versus the probability of them not being impatient and being patient, having this, okay? And so we're trying to the constraint is this. We're maximizing this subject to the utility of the represented agent. That's the bank's, that's the objective, okay? And so the bank's constraint then, we can derive the bank's constraint, okay? And by doing this, we can promise to pay C1 to the lambda impatient depositors at t equals 1. All right. The bank then must invest. It must invest lambda times C1, okay? And so because it must invest lambda times C1, this has to go to the illiquid asset, okay? So this goes to the illiquid asset. Okay? And so because this goes to the illiquid asset, we will convert it into a high return. We will convert that impatience into the high return asset, okay? And reap that. The investment yields, okay? So the investment will yield 1 minus lambda C1 of t, okay? Times r at time t is equal to 2, okay? And this amount is distributed among, so it's distributed. It's distributed among the 1 minus lambda patients depositors. All right? And therefore, a bank's resource constraint connects these consumptions. So inherently, the bank is able, its constraint is to relate these consumptions together and connect them in such a way that we have, the patient people who reap the consumption at 2 is equal to 1 minus whatever that the impatient people had, or whatever the magnitude of the impatient people reaping that first kind of consumption, times the return, okay? This would imply then that the second consumption should be equal to lambda minus the impatient consumption, the consumption at time equals 1, minus 1. Basically, we're just quotienting it by the patient people times the return. All right. And so this is the bank's constraint. Okay. Now what we need to do is optimize this. And so in order to optimize this, we can substitute this constraint here into the objective equation. All right. And so to substitute this this constraint into the objective equation, we would then, with respect to C1, of course, we're getting all of our variables, because everything really will then depend on the consumption, which is lambda utility C1 plus 1 minus lambda of utility of the utility of lambda C1 times R divided by 1 minus lambda. All right. The first order condition of this then, if we were to take the variation of this with respect to the utility function, we would have that lambda u prime, or the derivative of the utility function, minus 1. Okay, so this again is the impatient, the probability of an agent being impatient, the probability of them being patient, times the derivative of this scaled. We're scaling it effectively by this factor of 1 minus lambda of negative lambda times the return over 1 minus lambda, and then we're setting that equal to 0. All right. When we set that equal to 0 and try to find the extremal values of this, the bank then, the bank's constraint, as well if it is its objective, right? What we can then have is that lambda times the utility function, the derivative of the utility function is basically this, okay? C2. And then this should give us that u C1 prime, the derivative of the utility function of consuming something right now, must be equal to the returns that I reap times the derivative of the utility function at C2. Okay. Let's interpret all of this. All right. This is a very interesting kind of development, but it basically says that since R, we're constraining the return, right? R is greater than 1 inherently. This optimal contract, with this constraint, this optimal contract will then imply that UC1, right, the derivative of the utility function of 1 should be greater than the derivative of the utility function with respect to 2. And since this utility, of course, is concave, this then means that C star of 1 is less than C star or 2. Okay. This provides a partial but not full insurance. It does not set them equal to each other, because it is efficient to take advantage of the high return R for patient depositors. And crucially, the bank offers what the bank offers to impatient depositors is a better outcome. Basically, the better outcome is that C1 star is greater than 1. Okay, and that the bank could achieve with certainty, or basically the bank can achieve something that a self-insurer cannot achieve in autarky. And this offers patient depositors a better outcome as well, which is that C2 is greater than C1. Okay, so by pooling risk, and when we pool risk, the bank improves welfare for everyone in general. This is the economic justification for maturity transformation, which is the insurance of liquidity. Now, this comes with a caveat. Okay, this comes with a caveat because the very structure allows the bank to create value, or the structure that allows the bank to create value also makes it extremely fragile. So the bank's promise to depositors is sequential, okay? So it operates on first come, first served. Okay? It operates on this first come, first served basis, and it only holds enough liquid assets to cover, so only covers the probability of, some lambda impatient depositors. Fundamentally. And if more than lambda depositors, so if lambda is greater than what the bank is prepared to do, and they try to withdraw at t equals 1, okay? When they try to withdraw, the bank will be forced to prematurely liquidate its illiquid assets, okay? And so premature liquidation of liquid assets. And what this then does is, and of course this comes with a loss, right? Because of the trade-off inherently that we rigorously established that comes off with liquidity versus return, right? So that's what happens with liquid assets. So if we jeopardize, basically, if the bank jeopardizes its ability to pay those who wait, this creates a strategic. So this creates a strategic interaction among depositors. So let's talk about this. This is where game theory starts to come in, right? The theory of games. So this is a very famous result in game theory, which is called the depositors' coordination game. And let's consider the decision of a single patient depositor at t equals 1 in our 3-period economy. They know the bank has promised such C1, C star 1, and C star 2, such iterations of these consumptions, of course, with the expectation that the reward at the consumption at a little later time should be greater than the reward that I reap at by being impatient. So scenario 1, let's talk about the first scenario. The first scenario is that she believes other patient depositors will wait. So only if the lambda truly impatient depositors withdraw, the bank remains solvent. So bank is solvent if the lambda impatient depositors withdraw. Okay? These are the suckers, right? The suckers withdraw early because they need to feel the derivative of their utility function. They need that. They need to inject that piece of happiness or that piece of they need to inject it right now. They're slow term. Okay, they have a short run kind of basically to the depositor's coordination game, right? The patient depositor thinks the lambda people are suckers, right? So 2, she believes that. The second scenario would be that she believes all other depositors will run to the bank, okay? So if the other patient depositors panic, right? So if the patient depositors join the suckers, right? And join the impatient depositors and rush to withdraw at t=1. So they truly weren't patient after all, and they panic. The bank will quickly exhaust its liquid reserves. And so the game kind of says that then they will have to start liquidating its long-term projects, right? The bank is like, oh crap, I was expecting these people to remain patient, but now we're gonna have to liquidate our long-term projects for less than 1 per unit. Okay. So as more people withdraw, the value of the bank's remaining assets actually plummets. So it becomes a question of payoff, right? It becomes a conditional payoff. The condition is that the payoff, if she joins the run, if they join the run, they get C1 star, okay? They get it, okay? They get that iterated, consumption that they want. And, provided she gets to the bank before it runs out of assets, okay? Her payoff, though, if she waits, if everyone else runs, the bank will have very few, if any, assets left at t=2, okay? So her expected payoff from waiting will actually be close to 0. So faced with these payoffs, her best strategy then, or the solution to the depositor's coordination game, the best strategy to join the run, right? In this condition, okay? So there are, faced with these payoffs, we really just need to say that there are inherently two Nash equilibria. Okay? There exists two Nash equilibria. Or, in other words, the game has two rational outcomes. One is a good equilibrium, so we'll say a good equilibrium, or no run. All right? So patient depositors will believe others will wait, so they will all wait, and the bank is a self-fulfilling prophecy. All right, that's the Nash equilibria, okay? So the bank fulfills its value creating function, right? The value creating function from the constraints that we derived earlier. This equilibrium is based on pretty much confidence, okay, and belief in the entirety of the belief in the banking system. 2 is something we would call a bad equilibrium, okay? And this would be called a bank run. So this means that all the patient depositors will believe others will wait, so they all, the patient depositors believe others will run, so they all run. And the belief also becomes its own self-fulfilling prophecy, right? So we also have another self-fulfilling prophecy. Right? But this time it's not in the sense of believing that, all the investors, are going to be patient, but in fact, it's a panic that actually just destroys the bank. So even if the bank's underlying investments were perfectly sound, this equilibrium is based on fear. So the constraint equations for the utility functions, and the derivatives of the utility functions scaled by those impatient savers, wanting liquid and liquid assets, okay, different definitions of them. This equilibrium is actually based on fear. So this bad equilibrium is based on fear, this good equilibrium is based on belief, okay? So this I mean, they're both based on belief, right? But this one's based on a not fear, okay? It's logic, okay? No, but they're both rational outcomes, okay? They're both rational outcomes inherently. They're actually, it's not emotional. It's not an emotional response, because if they wait until the next period, right, the illiquid period where they expect to have their long-term payoff, they're going to get nothing left because the bank was solvent. The bank was destroyed. So it's more rational for them to join the crowd. Okay, so that's why it's a bank-run equilibrium. It's a bad equilibrium. So this result is really profound, because the banks are not necessarily the result. Bank runs really are not the result of some bank insolvency or bad investments. They're actually pure coordination failure. Pure coordination failure among rational depositors. Okay. Let's talk about policy responses to systemic risk then. Okay. So the very mechanism that we use to construct the entirety and derive the objective of the bank, also can be turned on its head. And so what we need to do then is say, how do we respond to systemic risk, right? The existence of a bad panic equilibrium provides a strong justification for public policy interventions, all right? We have to design them to prevent coordination failures and ensure this inherent financial stability. The model points to three primary solutions. The first is the suspension of convertibility. So they suspend basically the banks. So a bank can announce that it'll temporarily, stop the paying out of deposits, once it has serviced the expected fraction, right, of impatient depositors, right? And once we've serviced that, this breaks basically the logic of the run, right? You actually can't pull your money out, okay? This is literally what they had to do during the 2008 financial crisis, when they were buying these swaps on the basically on the credit rating agencies. And at a certain point, there was a bunch of people trying to pull out of the swaps because they were like, hey, things are going really crazy right now. They're like, no, we're not going to let you. You just can't. You're not going to be able to pull out. All right, because we've already served our expected fraction of the depositors. So a patient depositor who knows the bank will suspend payments actually so the patient, the 1 minus lambda depositor has no incentive. Okay, the incentive is gone for them to rush the window because they will be turned away anyways, right? So the best bet really is just to wait until t equals 2, right? So while this is effective, this can be disruptive to the payment system, okay? This can be a little disruptive to the actual engineering of our payment systems or the technology, right? So, okay, let's also call the lender of last resort. This is another one. And the lender of last resort, we'll call this LOLR. A central bank can act as a lender of last resort, providing short-term liquidity to a solvent but illiquid bank. Okay, so if the banks have a bunch of illiquid objects, but they went solvent, or if they're solvent, the bank can lend. Basically, the central bank can lend the bank the liquid funds it needs to pay its depositors at t equals 1. Okay, and this would take the bank's illiquid kind of long-term assets, and what would happen is the long-term assets will be taken as collateral. Okay, so because the bank can now satisfy all the withdrawal demands without any costly liquidation, the incentive for patient depositors to run again disappears. So the mere existence of a credible lender of last resort can prevent runs from starting, which is very good. And the last thing is the deposit insurance. The most robust solution, is a government-backed deposit insurance. So a credible government can guarantee to repay depositors in full, even if bank fails. Okay. even if bank fails. It's basically government intervention. This is the function of a government, okay? In an economic sense. A credible government will guarantee to repay depositors in full and, removes any reason to panic. So, if the contingency, right, of if a depositor funds are safe, whether they withdraw now or later, they will choose to wait for the higher patient payoff, so the payoff that is more patient. And this would then eliminate the bad equilibrium entirely, okay? We want to eliminate the possibility of this bad equilibrium solution to the Nash Equilibria, okay? All right. The solutions then to financial fragility create a new challenge. And of course, this challenge, again, it came up previously, but it's called moral hazard. All right? Philosophically, okay, if depositors are fully insured, they have no mathematical incentive to monitor their bank's behavior. So why worry if the bank is making prudent loans when the government guarantees your deposit, right? So this can lead banks to take on, so banks then can take on excessive risk. Okay, so we have like a second order moral hazard, not just for the lenders, but we have now the moral hazard of the bank taking on excessive risk. And knowing that if the bets pay off, the bank can keep the profit, but if their bets fail, the government or the taxpayer will cover the losses, right? So the government, or basically the government is funded by us, the taxpayer, right? So this will create this fundamental kind of trilemma of banking regulation, right? So the trilemma then, okay, is not a dilemma because there's three things involved. The efficiency then, the efficiency gains from maturity transformation, okay? So gains from this entire idea of maturity transformation. Okay. Second is the stability provided by a financial safety net. Okay. Like some deposit insurance. And then three is the market discipline. Discipline to basically prevent excessive risk taking. Or gambling, basically. All right. So it's difficult to achieve all three of these things simultaneously. Okay. And much of modern banking regulation, from these conditions for capital requirements to supervision and resolution authority, this is all an attempt to manage this basically very difficult trade-off, right? And to make an analogy with physics, right? We have a solution for orbits, of planets and stuff. They exist, right? If here's the sun, here's Mercury, it does this thing, and we have the closed form solution for off to infinity. Or if we were to perturb the orbit a little bit, if we were to perturb the orbit a little bit of Mercury, it would look something like this, right? Sorry, that's really bad. It looks something like this, where it's, it's aphelion, perihelion, precess, and then you would see it make some kind of thing like this in the sky, right? We can solve for those things in physics, right? But what's incredibly hard about this, just to draw an analogy, between the objective of a bank and the regulation of a bank, it's inherently a three-body problem, right? It's a three conditions that are really non-trivial, right? If we have some object, some sun here, and we have some Earth here, and then we have another planet here that's close, we have no idea how to solve that. Okay, there's no just closed form analytical solution to solve that in general in physics, right? That's why the entirety of the periodic table is derived with some Schrodinger equation magic, right? For our spherical harmonics, we treat everything like a hydrogen atom, pretty much, and then inherently get things right. And of course, like around the elements of like 116 or whatever, the periodic table starts to fail, right? Like the noble gases actually really are halogens and things like that. So just to make that analogy, okay, to the three-body problem, here's the trilemma of basically banking regulation. All right, thank you for watching. Hopefully this was interesting. And let me know if there's anything you like about this, or if this is something that you find interesting, or if there's something that you despise about the way that I'm going